Quick question. Do you think there's a federal law that says your bank account has to have a minimum balance in it, or the government will fine you? A lot of people think that. And honestly, it's an easy mistake to make, because almost every bank does have some kind of minimum balance rule. But here's the twist. There is no federal law that requires you, the customer, to keep a minimum balance in your account. So where do these rules actually come from? Who's really in charge here? The government or the bank? Stick around, because the answer might change how you look at your next bank statement. Welcome back to Money Regulation Hub, the channel where we break down the confusing world of banking and financial rules into plain English. Today, we're tackling a topic that trips up almost everyone at some point: minimum balance requirements. You've probably seen the fee on your statement, monthly maintenance fee, $12, and wondered, is that legal? Can they just do that? Is there a federal rule protecting me here? By the end of this video, you'll know exactly where minimum balance rules come from, which federal laws actually apply to your bank account, why banks set these requirements in the first place, and most importantly, how you can avoid paying unnecessary fees because of them. This isn't just trivia. This is money that comes straight out of your pocket every single month if you don't understand the rules. Let's get into it. Let's clear this up right away. There is no federal law, not one, that tells you, as a consumer, how much money you must keep in your checking or savings account. The federal government does not set minimum balance requirements for individual customers. So why does almost every bank ask for one? Because minimum balances are a business decision made by each individual bank or credit union, not a legal mandate. A bank might tell you, keep $1. $500 in this account or we charge you a $10 fee. That number and that fee is set entirely by the bank's own policy, not by Washington. Think of it like a gym membership. The gym can decide to waive your monthly fee if you show up a certain number of times. That's their internal rule, not a law. Banks operate the same way with balances. Here's where it gets interesting, because there are federal rules involved, just not the ones people assume. The main one is called the Truth in Savings Act, and it's enforced through something called Regulation DD. This law doesn't tell banks what minimum balance to charge. Instead, it forces banks to be completely transparent about it. Under this rule, your bank has to clearly disclose, in writing, things like the minimum balance needed to open the account, the minimum balance needed to avoid a fee, how the fee is calculated, and the interest rate you'll earn, if any. In other words, the federal government isn't setting the rule, it's making sure the bank can't hide the rule from you in fine print. That's a huge distinction. The regulation exists to protect your right to know the terms, not to control what the terms are. So next time you open a new account, that thick disclosure document you scroll past, that's the federal government making sure the bank can't surprise you later. Now let's talk about the bank's side of this. Why do they even bother with minimum balances? It comes down to cost and risk. Every account a bank manages costs them money: staff, technology, fraud protection, customer service. A bank makes more money and takes on less risk from a customer who keeps a healthy balance because that money can be lent out or invested elsewhere. A customer who keeps their account nearly empty is more expensive to serve relative to what the bank earns from them. So banks use minimum balance requirements as an incentive. Keep enough money with us and we'll waive the fee. Some banks will also waive it if you set up direct deposit, or if you're a student, or if you link multiple accounts together. These are all just variations of the same idea: the bank rewarding behavior that benefits them financially. Here's a real-world example. Imagine two customers, Sarah and Mike. Sarah keeps $2, Zuzo in her checking account at all times. Mike keeps $50. Even though they're paying the same fees for the exact same account features, Sarah's bank is essentially making money by having access to that $2,000 to lend out, while Mike's account barely breaks even for the bank. That's exactly why Mike's bank might charge him $12 a month unless his balance goes up, while Sarah pays nothing. Now, here's where a lot of confusion comes from, because there's another federal rule that also has balance in it, but it applies to something completely different: Regulation D, also called reserve requirements. This one doesn't apply to you as a customer at all. It applies to banks themselves. Historically, the Federal Reserve required banks to hold a certain percentage of their customer deposits in reserve, meaning not lent out, as a safety cushion. This is a bank to Federal Reserve rule, not a bank to customer rule. Here's the twist. In March 2020, the Federal Reserve actually reduced this reserve requirement to 0% for all banks. That means, technically, banks aren't required to hold any minimum reserve based on customer deposits anymore. This was a move to give banks more flexibility to lend money during a period of economic stress. Why does this matter for you? Because you'll sometimes see people online referencing Regulation D as though it limits how much money you can keep in a bank account or how many withdrawals you can make. There used to be a rule limiting certain withdrawals from savings accounts to 6 per month under Regulation D, but that withdrawal limit was suspended back in 2020 as well. Many banks still enforce their own version of a withdrawal limit as an internal policy, but it is not currently a federal requirement. If there's one federal balance rule that genuinely matters for your money, it's this one: FDIC insurance limits. The Federal Deposit Insurance Corporation insures deposits at member banks up to $250,000 per depositor, per bank, per ownership category. This means if your bank fails, the federal government guarantees you'll get your insured money back up to that limit. This is different from a minimum balance rule. It's a maximum protection rule. It doesn't tell you how little you must keep in an account. It tells you how much is protected if things go wrong. If you have more than $250,000 in a single bank, in a single ownership category, the amount above that threshold isn't automatically covered. That's why financial advisors often recommend spreading larger sums across multiple banks or account ownership types. Credit unions have an equivalent system through the National Credit Union Administration. Ensuring deposits up to the same $250,000 threshold, let's bring this back to something practical. Since minimum balance requirements come from your bank, not the government, that means you have more power here than you think. First, shop around. Many online banks and credit unions offer accounts with no minimum balance requirement at all because they have lower overhead than traditional branch-based banks. Second, read that truth in savings disclosure we talked about earlier. It will tell you exactly what triggers a fee, whether it's a daily balance, an average monthly balance, or something else entirely. Third, ask your bank directly whether fees can be waived through direct deposit or account bundling. Many people don't realize this option exists simply because they never asked. And finally, remember that switching banks is easier than most people think. If your current bank's minimum balance rule doesn't fit your lifestyle, there's likely a better option out there that does. Let's quickly recap what we covered today. There is no federal law requiring you to maintain a minimum balance in your personal bank account. That rule comes from your individual bank's own policy. The federal government's role through the Truth in Savings Act and Regulation DD is to make sure banks fully disclose their balance requirements and fees, not to set those requirements themselves. Banks set minimum balances because it's more profitable and less risky for them when customers keep higher balances. Regulation D relates to bank reserve requirements, not customer minimum balances, and the reserve requirement itself was reduced to zero in 2020. FD Insurance protects up to $250,000 of your deposits per bank, per ownership category, a completely separate concept from minimum balance rules. And because these balance rules are set by individual banks, you have the power to shop around, negotiate, or switch to accounts with no minimum balance at all. Understanding this difference between government regulation and bank policy is one of the simplest ways to take back control of your money. And that's it for today's video on federal rules and minimum bank balances. If this helped clear up some confusion, do me a favor and hit that like button. It genuinely helps this channel grow. If you haven't already, subscribe to Money Regulation Hub so you don't miss the rest of this series on banking rules that actually affect your everyday life. I'd also love to hear from you. Drop a comment below and let me know. Has your bank ever charged you a minimum balance fee, and were you able to get it waived? Your story might help someone else watching this. And if you know someone who's constantly complaining about mystery bank fees, share this video with them. It might save them some money. Next time on Money Regulation Hub, we're diving into overdraft fees, how they work, the federal rules that recently changed around them, and the exact steps you can take to make sure you never get hit with one again. Trust me, you won't want to miss that one. Thanks for watching, and I'll see you in the next video.